This Road to Prosperity video is sponsored by Vandergraaf. Visit vandergraaf.com to learn more about how their advanced drum motor technology reduces maintenance costs while delivering reliability and longevity for belt conveyors operating in the harshest of environments.
Hey everybody, Kevin Yanik at Fit & Quarry with you again. We've got with us again George Reddin and Rob Mineo from FMI Capital Advisors. George, Rob, thanks for joining us today.
Good to be here. Thanks for having us.
We're visiting right at the end of July, just about, and we're on the verge of getting some second quarter reports from the industry's construction materials producers. I haven't seen any yet. I don't know that any have come forward yet, but what are your expectations as we're kind of on the doorstep of those about to come forward?
So, second quarter is, we're sort of also looking back at Q4 and Q1 of this year, and the themes there were strong demand, good pricing, good performance, and everything we see out there suggests those dynamics remain. Demand is strong. A lot of people are selling everything they can produce. Prices are improving, and we actually expect to see the smaller producer benefit from price increases this year. They may not have been as quick to increase prices as the public companies were. The only challenge we heard in the last two quarterly reports was related to weather. We tend to take a look at what NOAA provides on weather, and just as a high level perspective, it doesn't look like Q2 weather would be dramatically different than Q2 of 22. So, cautiously optimistic that the folks are going to be reporting good results. The issue in the first two quarters, the last quarter of 22 and the first quarter of 23 was that volumes were flat, if not down for many people, modestly down. And so I think we're going to be looking at that and seeing what U.S. Geological Survey starts reporting on volumes.
I'd say the only thing to add to that on the weather note is that, like all construction, weather is local, construction is local. You've got different scenarios. So take an example like Texas, exactly like George said, going strong, similar weather patterns last year to this year, high demand, market's doing great. The California, Nevada area had some really rough weather end of year last year, beginning this year. And while Q2 didn't have as bad weather, what I think you need to notice is a lot of the snow that was accumulated in the mountains during Q1 started melting during Q2. So there's still a weather impact, even though it's not a precipitation increase that you might see year over year. So I think certain markets still certainly do feel the pressure of weather, but it's hopefully lightening up as the precipitation rates are normalizing.
One thing that FMI does that's somewhat interesting is you guys benchmark where the construction materials industry, the public companies, and how they're performing against the S&P 500, against the Dow Jones Industrial Average. And of late, it seems like the trend is that the CMI companies, your construction materials index companies, they're outperforming the general market. So what are they doing? What's happening with those companies that they seem to be performing a little better than the typical company out there?
I think it's a great question, and we definitely see that trend right now. I think to set the stage, the first thing to say is that a rising tide, lifts all ships. So you're seeing the general market kind of on a short bull run right now, as recession outlooks kind of have decreased or postponed, and that's going to raise, the construction materials index as well. But why we're seeing that difference is I think that you're starting to get the public markets are taking notice and rewarding the sector for certain things like the IIJA starting to roll out more. Demand's very high, so a lot of price increases. And when you get price increases, you get performance that outpaces the market growth. And that's where you start seeing investors kind of looking at the space as an attractive place to go in.
Yeah, the only thing I'd add to that, Kevin, is that the concern over the last few quarters has been residential. After the boom that we had post the beginning of the pandemic. And it's actually done a little better than people thought, right? That took a little risk maybe out of the equation as people looked at the sectors. For example, new home starts are up 20% since the beginning of the year. The median new home price is down 10%. Those are good dynamics, but it's really a supply and demand issue, right? The lack of supply is keeping the residential sector in a better position than we thought. Now, that said, single family home construction put in place is expected to be down 16% this year. but better maybe than we thought a few quarters ago.
Guys, let's switch gears and talk a little bit about what's happening with mergers and acquisitions right now. Like, we're not seeing that mega deal or those big deals that we saw a couple of years ago go down. It seems like the reports that we're seeing is that the bolt-on activity is really what's kind of happening, and what producing companies, buyers are comfortable with at this point in time. So what is happening? I mean, we're more than halfway into 23, and what's taking place on the M&A front so far, 7 months into the year?
Yeah, so in times of uncertainty, you have a flight to safety. And in the mergers and acquisitions business, safety is towards smaller bolt-on deals in markets that you have strategic reasons to make those acquisitions. And we continue to see that, people filling in their networks rather than looking to expand with the big ones. The other thing is we did have quite a few major ones, and those major ones, Vulcan buying US Concrete, Martin Marietta buying Lehigh Hanson's assets, Holcim doing a lot of major acquisitions, maybe outside of the core construction material sector. That requires integration and strategy efforts. So they're busy, right? They may not be doing as many deals right now, but they're integrating some major ones. And, I think as we see things improve, we should expect a good second half of the year.
Yeah, the only caveat I would add also is that you could classify Knife River's spinoff from MDU as a mega deal or transaction. Not saying the question's wrong, just saying that it's not traditional, but that's a very large occurrence in the marketplace, and that did happen this year.
Well, George, you touched a little bit about second half 23. Do you guys have a feel for what 24 may look like? What dynamics are at play that might change the nature of M&A activity? What needs to happen for people to get a little bit more confident at this stage? And is there a time frame on people getting a little bit more comfortable and confident to do bigger deals?
I wish there was an easy time frame to give. Truth is, like George said, uncertainty tends to anchor markets and kill deals. But what we're seeing now is we've heard for 6 months or we've heard for a year that the recession is 6 months away, and it's becoming almost a new normal. The economy defies a lot of traditional understanding, whether in a recession or not, whether it's going to happen. I think a lot of the predictions on recession have either been continually postponed or being lessened, this idea of a soft landing. So when the firms who are buyers tend to get their feet under themselves and recognize this is the new normal, they still need to make acquisitions, they still need to grow. So our expectation is that whether or not it's kind of a remaining economy how it is right now, or it kind of picks up, either of those things should lead to an increase in M&A.
Yeah, I think you have to look at it a little bit from the buyer side and a little bit from the seller side, right? The buyers are at least half of the deals that we do are with the public companies. They are compelled to grow. The vital signs for those companies are very good. Their cash positions are good. Their access to debt's good. Their leverage ratios are at or below normal levels. So they're poised for acquisition. Again, the uncertainty issue. On the seller side, they've heard so much about this IIJA and they're thinking maybe we'll get through this recession unscathed. And so tends to put a little paralysis into that decision making. But that is clearing up as each quarter. So we do expect the second half and into 24 to be pretty robust.
George, you touched on volumes and how those are pretty healthy. They're keeping tabs, and curious about what the U.S. Geological Survey is going to be putting out there. The IIJA funding, I feel like we're in waiting mode, waiting for these funds to come out. I feel like maybe there's some development and change there. What sense do you have on how IIJA funding disbursement is at this point, and what impact is it having, if any, at this stage?
Yeah, sure. So I think it's difficult to exactly pinpoint the source of funding for a lot of projects. There are a few that you can tie exactly to IIJA. A lot of it is kind of a blend of state and federal funding, or the federal flowing into the state. So a lot of what we're going to say to answer this question is a little bit water cooler. I don't know that you can point to these big projects, but what we're hearing is that the funding is now starting to flow. I think the big bottleneck was they got handed all this money, and then you had a labor shortage, not only who could do it, but also the engineers who could lift the work, and kind of the planning and all the bureaucracy and work that goes into getting the work out. I think that is starting to loosen up, and we're seeing the funds flow. And I think that additionally, a lot of the grants that are kind of above the baseline funding we talked about, they are being allocated. Now, some of them are going to projects like rails and things like that, ports. You've seen a lot of announcements about things there. Still drive the construction materials industry, not as much as maybe highways do, but still big players. And I think you're going to start seeing kind of both sides come together, and the money, especially in 24, really start to be seen.
Yeah, and the only thing I'd add to that is labor, right? At the Departments of Transportation, when this IIJA Act passed, the challenge was, how are we going to get the work out? How are we going to hire the engineers in the market, whatnot? That is, they're getting their feet on the ground and moving now on that. On the customer side, for the aggregate producers, their labor's a bottleneck. Asphalt paving contractors can't put crews together with qualified labor. Ready-mix concrete companies can't find the drivers. So you're finding people at capacity in many regards. So while we would love to see more IIJA money out there, capacity from a labor standpoint is also a restriction.
Let's talk too about the other key markets related to construction materials. I mean, non-building, whether it's roads, bridges, or highways, is huge, obviously, but there's some interesting activity or non-activity, I guess you could argue, in residential and non-residential construction. What's the latest that you guys are seeing in those two areas? And maybe you can offer a little bit of detail, what's driving non-residential and what's maybe slowing it down at this stage?
So let's look at it overall first. Census Bureau buckets all construction activities into three categories: residential, non-residential, and non-building structures. So overall, we're forecasting a 3% increase. So we're increasing this year, but it's at a lower rate than last year. Residential single-family homes will be the only category that we're forecasting that will grow, have negative growth rate this year. It is 16% decline for a single family, offset by 12% increase in multifamily. And so we'll have a net decrease of about 6% in what the Census Bureau captures as residential. Non-residential, all the categories are up. Some of them are small categories and coming off of pretty significant declines. So the percentage increase is off of a low level, but still trending in the right direction. The real benefit in the non-residential is the manufacturing sector. The CHIPS program is helping that. And then in what we call commercial within non-residential, 50% of that category is now warehouse and distribution. And again, those are attractive opportunities for our concrete producers and asphalt producers, and therefore our aggregate producers. On the non-building structure, you're going to have the heroes in there are going to be the infrastructure-oriented components, highways and streets, for example. So non-building is expected to go up 9% this year. So overall, 3% increase, residential down 6%, the non-res up 14%, and the non-building structures this year we're expecting to be construction put in place increasing by 9%.
Let me just add a little bit of color on the residential side, because I think what is being predicted and what everyone's kind of lived through in their experience is being challenged right now. And I think there's some dynamics that even the Fed, I was reading this morning, isn't really sure how to handle, because if you bought into a mortgage at 3 or 4%, and even if you want to buy a new house, you're very unlikely to sell what you have and buy something new at a 7% rate. You're just not going to get what you had dollar for dollar previously. So when you look at the total debt held by the American public on mortgages, the Fed increase is only affecting maybe half of that. Because of that, you've got this huge flow of demographic shift of people in the late millennial stage who are now buying houses who might have put it off. You've got a larger population movement going there. So there's a lot of demand, and the supply is not there for existing homes, which then drives people to build new homes. But this is coming at a time where interest rates are higher for new homes that would naturally drive a decline in residential. So that's why you have kind of everyone's expecting for the worst, and then there might be an increase. Things seem okay, but it's a little bit of a question mark. And I don't think anyone should be making predictions about it because the dynamics are in a place that we haven't seen before.
Well, George, Rob, appreciate all the perspective on a variety of topics from markets to what's happening with the IIJ funding and more. Looking forward to getting back together maybe another quarter and see what's happening coming out of Q3.
Absolutely.
Thanks, Kevin.
Thank you to Vandergraaf for sponsoring this Road to Prosperity video. To learn more about how their advanced drum motor technology reduces maintenance costs while delivering reliability and longevity for belt conveyors operating in the harshest of environments, visit vandergraaf.com.